Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, ECB unveils a permanent global euro liquidity backstop, a geopolitical move challenging the US dollar's exorbitant privilege. We'll analyse why this was announced at a security conference and what it signals for the future of the global currency system. Second, Australia's central bank hikes rates on a spending boom, just as a 15% retailer stock plunge suggests the consumer is already cracking. So we'll discuss why the RBA is reacting to a spending surge from wealthy households and what this policy dilemma means for the Australian economy. Third, a $3.2 billion US plan to tax Chinese ships and revive shipbuilding is paused, leaving the bipartisan goal in high-stakes limbo. We'll examine how this economic ceasefire with Beijing impacts US industrial policy and what it means for long-term supply chain risks. The European Central Bank just fired a major shot in the global currency wars. It announced plans to make its emergency euro liquidity backstop permanent and available to every central bank on the planet. This isn't just a technical update. ECB President Christine Lagarde delivered the news at the Munich Security Conference, a first for an ECB chief, and her reasoning was stark. She warned of needing to avoid a situation that triggers fire sales of euro-denominated securities in global funding markets. In other words, the ECB is building a global firewall to prevent a panic-driven collapse of euro assets during a crisis. A while back, we analysed how doubts about the Fed's independence, right down to rare dissents from Waller and Bowman, were already nudging central banks to insure themselves against dollar-driven shocks. Today's development is the ECB stepping in to supply that insurance in euros. What really makes this a powerful signal is times it was announced a security conference, not a financial one. The ECB is stepping beyond its traditional role. This move positions the central bank as a geopolitical actor, using its financial power to build a strategic bloc that is not centered on the US dollar. What we're seeing is the line between monetary policy and foreign policy becoming increasingly blurred. Continuing our last discussion, the ECB is leaning into that blur and making it policy architecture. However, if you zoom out, you'll see another layer of strategy at play. This move is a direct challenge to the US dollar's dominance. The US Federal Reserve has a similar tool to protect its own treasury market. Now, the ECB is rolling out a competing global safety net. We previously highlighted how political risk around the Fed, remember the wash headlines and even prediction markets pricing leadership upheaval, was feeding a broader search for alternatives. Today's announcement offers the plumbing for that search. The key here is the strategic difference. The Fed's facility is often seen as a crisis response tool. The ECB's new facility, however, is a permanent, preemptive piece of financial infrastructure. And as we've discussed before, this directly intersects with concerns about the weaponization of the dollar. By creating a reliable, non-dollar-based liquidity source, the ECB is essentially providing a blueprint for a more multipolar currency system, one where the influence of US financial policy might be reduced. The backdrop for this is what the source material describes as investors reassessing the dollar due to the unpredictable nature of US President Donald Trump's economic policy, creating an opening for the euro to gain market share. When we covered this a while back, we noted IMF reserve data showing the dollar's share slipping and treasury figures pointing to foreign net selling early signs that diversification wasn't just talk. Today's move by the ECB aims to turn that drift into design. This isn't just a theoretical concern for investors. Major global players are already acting on it. For instance, the People's Bank of China has been actively diversifying its massive foreign reserves. As we've noted, that has included a multi-month gold buying spree and increasing holdings of euro-denominated assets. This move by the ECB could make holding euros even more attractive for central banks like the PBOC, as it de-risks their portfolios from US policy volatility and deepens the financial links between Europe and Asia. The takeaway is that this creates a viable, liquid alternative to the traditional safety of US government bonds. The new facility, to be available from the third quarter of 2026, will offer standing access for up to 50 billion euros. By guaranteeing access to euros, the central bank is creating a powerful incentive for financial institutions worldwide to buy and hold more euro-denominated assets. Lagarde herself stated this move reinforces the role of the euro and boosts confidence to invest, borrow and trade in euros. And this timing is no accident. As we've discussed before, it directly challenges a core pillar of American economic power known as exorbitant privilege. This is the benefit the US gets from the dollar being the world's primary reserve currency, which allows it to borrow more cheaply. If the euro gains a larger share of global reserves, this could, over the long term, erode that American privilege and potentially lead to higher borrowing costs for the US government and corporations. This isn't just about preventing a crisis. It's a calculated strategic play to elevate the euro's status as a global reserve currency, setting the stage for a new level of competition in the world's financial architecture. Looking ahead, a few key indicators will tell us if this gambit is paying off. The first thing is adoption. We need to see which non-euro central banks, especially in emerging markets, actually sign up to use this facility after 2026. Their participation will be the true test of its success. Second, keep an eye on the IMF's quarterly data on global currency reserves. We've been tracking those releases in earlier episodes, and a sustained increase in the euro share would be a clear sign this strategy is working. Finally, the ball is now in the Federal Reserve's court. A while back, we used prediction markets as a live gauge of US policy risk. Now, uptake of the ECB's backstop and those reserve numbers become the new dashboard for this evolving financial landscape. All market information is subject to change. This content is for informational purposes only and is not investment advice. Speaking of central banks making big moves, the Reserve Bank of Australia is facing a completely different kind of puzzle on the home front. That new coffee machine you bought with your tax refund, it might be the reason they just hiked interest rates. Policymakers thought Australian households were tapped out, but they were dead wrong. A sudden surge in spending on durable goods sent shockwaves through the economy. Appliance maker Breville reported double-digit revenue growth, fueled by sales of $700 coffee machines. Premium furniture retailer Nick Scali posted a 13% lift in sales revenue. And online retailer Temple & Webster saw its revenue jump 20%. Now, get this spending isn't coming from everyone. Research shows it's heavily concentrated among older, wealthier households. These are people who likely own their homes outright and have significant savings, so they are far less sensitive to interest rate hikes. This creates a real headache for the central bank because its main tool for fighting inflation, raising rates, disproportionately squeezes younger, indebted families without effectively curbing the spending of the group that's actually driving the inflation. The situation presents a fascinating duality. Australian households are carrying debt levels that would normally signal major financial stress, yet they're not acting stressed. This suggests a potential structural shift where people have become more accustomed to leverage, making the central bank's old models for predicting consumer behaviour less reliable. It seems a little financial relief from tax refunds and prior rate cuts was all it took for consumers to feel confident again. But the Reserve Bank of Australia was watching. RBA Governor Michelle Bullock went on the record stating that this very spending on durable goods was a key driver pushing inflation higher. The central bank saw these purchases as a canary in the coal mine, a warning sign of more permanent inflation that's hard to reverse. Interestingly enough, this goes against the global trend. While most major economies are seeing inflation cool down, Australia's durable goods prices are reaccelerating. This is particularly striking because it's happening even as major trading partners like China are experiencing producer price deflation, meaning the prices of goods leaving Chinese factories are falling. This signals Australia's inflation problem is primarily domestic. It's not being imported. It's being driven by local factors like supply bottlenecks and strong retailer pricing power. This puts the central bank in a tough spot, limiting its ability to rely on global trends and forcing it to focus on crushing domestic demand. Their response was swift and decisive. The RBA raised the cash rate, ending its shortest rate cut cycle in 30 years, and explicitly pointed to consumer spending as a primary cause. This is where the situation takes a more complex turn. Just as the boom seemed to be in full swing, the market delivered a stunning plot twist. In hindsight, there were already signs that this spending boom was built on a fragile foundation. That little financial relief we mentioned earlier, the tax refunds, was a temporary one-off boost. It didn't reflect a real sustainable increase in household income. In fact, real per capita disposable income in Australia has been falling. The risk then was that the central bank was reacting to a fleeting sugar high and that a policy misstep could tip a high debt economy into a hard landing. Shares in Nick Scali, the furniture retailer that had been reporting strong sales, suddenly plunged more than 15%. The reason? Weaker than expected January sales figures. The drop signals that the very consumer enthusiasm that forced the central bank's hand may already be vanishing, suggesting the spending party could be over before it even truly began. The real test will be in the upcoming data. We'll be watching the monthly inflation and retail sales figures closely. If inflation remains stubbornly high despite weakening consumer spending, it confirms the RBA's dilemma. This could lead to more volatility for the Australian dollar and for stocks, especially in the consumer discretionary sector. It's a delicate balancing act, and the central bank is walking a tightrope. We were just talking about China's deflation impacting Australia. Now, let's turn to a much more direct confrontation involving China and the United States. The Trump administration just unveiled a plan to resurrect America's shipbuilding industry, funded by a massive $3.2 billion annual fee aimed squarely at its rival. The strategy, detailed in a new Maritime action plan, was designed to be bankrolled by levying fees on Chinese-built vessels sailing into US ports. This was a direct response to a US probe that found China uses unfair practices to dominate global shipping. The core justification for this plan comes from a US Trade Representative's investigation, known as a Section 301 probe, which concluded that China's long-term strategy to dominate maritime and logistics industries was actionable, meaning it justifies trade remedies. And to be clear, this isn't just about ships, it's about economic security. This finding provides the legal backbone for the administration's entire plan. The move was expected to generate billions to revitalize an American industry that has been in decline since World War II. But here's a key economic ripple effect to consider. A plan this big, essentially a major off-balance sheet fiscal injection, could create its own set of challenges. Reviving shipbuilding would mean a surge in demand for steel and other raw materials, potentially bidding up their prices. It would also increase demand for skilled labour, which could lead to localised wage pressures. The knock-on effect here is that it could complicate the Federal Reserve's last-mile fight against inflation, as rising producer costs often pass through to consumers. But this financial salvo didn't go unanswered. China immediately retaliated with its own port fees on US linked ships. The tit-for-tat penalties quickly disrupted global cargo flows and pushed up rates. The stakes are incredibly high because this threatens to fragment the entire global shipping system. For decades, major carriers like Maersk and MSC have used what's called flags of convenience, registering ships in countries like Panama or Liberia to lower costs. A sustained US policy targeting Chinese-built ships could force these global giants to completely rethink their fleet composition. This could lead to the creation of separate preferential trade corridors that are far less efficient and more costly than the system we have today. Then came the twist. Just as the trade battle heated up, both sides hit the brakes, striking a deal to put the multi-billion-dollar levies on hold for 12 months. But that's not the whole picture. The administration's plan has significant overlap with the proposed Ships for America Act, a bill with rare bipartisan backing in Washington designed to do much of the same thing. This bipartisan support is a critical signal. It points to a durable, hawkish consensus on China that is solidifying in Washington. A single statistic really puts this into perspective. The US currently has only about 80 US flagged vessels in international commerce, compared to China's 5,500. This consensus will likely drive further strategic decoupling policies that go beyond just high tech, increasing long-term risks for any company with heavy exposure to the Chinese market, regardless of who is in office. But that bill has not made swift progress. This prompted a direct warning from US Senator Todd Young, a key sponsor of the act. He declared the administration's plan should serve as a, quote, wake-up call for Congress to act quickly. He added, it's time to make American ships again. The blueprint to rebuild a core American industry is on the table, backed by bipartisan calls for action. But its primary funding mechanism is currently frozen in a high-stakes economic ceasefire with China, leaving the future of US shipbuilding hanging in the balance. So what's the bottom line? All eyes are on that one-year suspension of the port fees. When that pause expires, the reimposition of those fees will be a leading indicator of where this is all headed. Renewed tariffs would almost certainly trigger fresh retaliation from Beijing, creating a new wave of supply chain volatility and directly feeding into the cost of goods. The entire situation is a test of whether this new industrial policy can attract the massive private investment needed to succeed, or if it will simply become a permanent subsidy program.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.